Hey everybody, President Brent here. Welcome to this free edition of our Trader User Group for the trading week ending April 17th, 2020. Thanks for tuning in. This week's theme is this a dead end street or is it a throughway? The past week we saw some really good performance out of the US markets. I mean, the Dow was up over 2.2%. Year to date, though, it's down about 15. The S&P, it saw a good week at a little over 3% to the upside, but year to date, it's down about 11%. So still in correction territory for both the Dow and the S&P. Nasdaq, it is up 6% this week. Year to date, it's only down about 3.6%. Really amazing. The Russell is the only one that is really bringing up the rear. It's still in bear market territory, being down year to date 26.33% from the from the highs. So really amazing. The VIX we saw come in a little bit. It closed this week at 38.15 from the prior week of 41.67. World markets were not that bad. I mean, the FTSE and the CAC 40 from France and the FTSE from London were roughly flat to down just a little bit, but we saw upside in the DAX, the Nikkei, China, Hang Seng. So we've seen, two really good weeks. The best sector performer this week in the U.S. was the communication sector, up about 7%. The worst was the banking sector, coming down 3.9%. More on that in just a minute. The trailing PE ratio, 12-month PE ratio for the U.S. S&P is about 22.10, still elevated. The forward PE ratio is a little bit lower, but in my mind is still elevated at 20.75. So the forward 12-month is lower from the trailing by about 6.1%, but I think that's too optimistic in my mind for the forward PE. Well, it should be a little bit lower. So that's going to suggest some downside here over the next 2 to 4 months. We got an annual dividend yield really of the S&P sitting a little about 2.1%. The 10-year interest rate is sitting at 65.4 basis points. So that's very low. So it's still going to encourage money to flow into the S&P. But what we're seeing is large cap growth stocks and large cap conservative, good, strong balance sheets, strong cash. Those are the ones that are doing well, with a couple of sectors really doing also very well, which would be the healthcare sector is doing good. But, as I said, the markets had more reason to cheer with the running of the bulls. From what I had said last week, we've had multi-week gains that are the best we've seen since 1974. And given the support, though, with the feds and the government agencies that's they've been given to the private sector, where and how will the U.S. government draw the line? I mean, just how much support are they going to give and how deep will they go? I mean, we've already seen the feds now getting in, poking their nose around ETFs in the bond market and the investment grade bond market and investing there, even possibly in high yield. So we got to watch that. But, now how are they going to draw the line as to what we're seeing now as each of the states starting to turn the economic engine back on? Who can go to work? Why will some be allowed to go to work while others can't? We're already seeing some folks around the country starting to demonstrate against some of the closures and some of the arbitrary rules, which I've seen, which really don't make sense. I think in one state, if you've got a canoe, you can go out and fish, but if you've got a motor on the canoe, you can't. So, I mean, some of these things are just, but that's government, right? So over the next 2 to 4 weeks, we're going to see the U.S. economic engine come back to life, but it's going to be fits and starts. Trump released his phased-in opening of the U.S. economy. And then on top of that, we had the potential drug treatment for COVID-19 by Gilead showing a lot of promise over in Chicago, and then the reopening of a large Boeing manufacturing facility, which is going to get 27,000 plus people back to work, gave us a very strong Friday where everything was just strong up. So let's see if that momentum is going to carry us over into the early part of next week. But we did see this past week, as I said, the worst performing sector was the financial sector, coming in about 3.91% to the downside. And we had earnings kickoff this week with a not with a bang. I guess you could say with a bang, but not the good kind. We had about six banks: J.P. Morgan, Wells, Citi, Bank of America, Goldman Sachs, Morgan. They all came in and they missed. But the primary reason why they missed is due to they every one of them increased significantly their loan loss reserves. I think it came to a combined $25 billion this quarter of potential loan losses. So that shows that the banks are really prepping if this economy stays sour for another 2 to 4 months. A lot of people are going to be defaulting on loans, and it's going to create some agita. So banks are really starting to increase their loan loss reserves, which they should, but that caused the key bank index to fall a pretty good bit, and the financial sector coming in as the worst performer of the top sectors in the S&P, which makes sense. So keep in mind, everything is going to be about these business comebacks and how quick we can get the economic engine going. I believe it's going to be kind of a start and stop process, those kind of things. Markets now are kind of pricing in a full restart will be in place by 2021, which I guess in my mind makes some sense. Kind of a linear type of process, but we all know it's not going to be linear. There's going to be, as I said, fits and starts to it. But the margin of error is going to be big if there's a big setback. So, like, let's say the virus reemerges and they have to close things down again. It's going to be a nightmare for the economy, and it's going to create tremendous negative consumer sentiment. So that's what some of the states are trying to avoid, because that would prolong the recovery, and move us into an even deeper recession than what we're in right now. So in all of this, as I've said, the public's got to feel safe. The consumer sentiment's got to be really, the final layer that's going to really get the economy running full steam again. So when you got that older couple willing to go to a crowded Chinese buffet for a meal and they're willing to do it, at that point in time, things are going to be rocking and rolling. In fact, Goldman Sachs came out with a lockdown index, and that lockdown index they measured as a percent of GDP. And right now, it's risen to 86%, which means about 86% of the GDP is locked down, in some kind of order. So that just shows you how solid the economy is turned off right now. And I granted there's some parts of it that are open and running, but most of it, for all practical purposes, is shut down. So it's going to be in everybody's best steed, especially the government, to get this economy running sooner rather than later, because I can tell you the federal government does not have enough money to spend in place of the economy. Maybe for the next 30 to 60 days, but that's it. So we're going to take a look at these charts here and just kind of see where it's going to go. But understand it's a binary choice, right? I mean, we're going to have a binary choice. Um, the way the markets are looking, there's going to be this binary choice. So now let me get a screen up for you guys just so that you can see here, because all you've been seeing is a little bit about just my face or my name on the screen here. So let me get that up for you. Let's just see here where we're going to go right here like this. So I'm going to get a chart up here on Ichimoku. And as you guys know, I like to use the 240-minute Ichimoku because that is the best chart time frame out there, kind of an x-ray view of the daily, right? And you can see on here how we've had this turn in the cloud from red to green. And you can see here the cloud serves as a support or a resistance point, depending on where price action is located in relation to the cloud. Okay. So now if we look at it, you can see each of these circles here was where we expected, and I was telling our members we're going to get some resistance. And every one of these we did. And we had a little bit of a pullback here. We had a deeper pullback here because we had that divergence. So that was an interesting play for us. We were expecting the pullback. And then right here, you can see we had this next level here because I was calling 2,800. And we came up to 2,750. We pull back, and then you can see this fib node sitting right here. Now this fib node, I'm going to show you a different chart that's got a different fib node on it. But this node of 0.236 goes all the way back. The pivot low was formed on March 9th, 2009, and the pivot high was formed this past February. So these are really long-term solid pivot points, and you can see where we held up here nicely, and then it's provided support and our resistance, and we've been trying to gesticulate above and below this key pivot area here, 2752. Okay, and now we've come up here and we've made these new highs up here, almost close to 2,900. The next level up that I have, that's not a fib node, but it's more of a key price level, is 29.73. Now 2900 is a round number. It tends to be any number that ends in a century mark, like 29, 28, 27, and so forth. We tend to bounce around a little bit, but the next upside is at 29.73. The next downside is this zone right here, right? And you could see right in this zone right here how we sat here for quite some time. And that would be from 27.53 roughly to 27.28. And if we break out down there, you can see we're right into the green cloud here, which is designed to provide support. And at the bottom of this right here, 2634. Okay. So these are next week. I want to stay either above, or I don't mind if we get back in here just a little bit, but I do not want to go below 2634. My line in the sand is this level right here. This is about 2,500. It's a key level. If we break that, we're coming back down a lot lower. We'll come down to this fib node down here and challenge these down here. Now, we still have a greater than 50% chance of coming back down and either retesting or coming close to the lows we've already made, even given this bull run that we've had. So just understand that, okay? Bull runs in bear markets can be strong, they can be fast, and they can be vicious. Primarily, you've got a short squeeze. I read some analyst report that said about 70% of this move was a short squeeze. I don't know how they get the data, and I don't know if I necessarily agree with it, but I will say that a big part of it was a short squeeze, right? How much, I don't know. My original target down here to make a lower low was sitting right around 2030 in the middle of that colored bar. Okay, but this Elliott wave count, this was based on an Elliott wave 5 coming down here, but I think the Elliott wave count is going to recount based on the length of this move here from 3 to 4 leg up here. It's going to be kind of an extended 4 leg pattern, but I just don't see it going this far here. This is really showing the attributes of an Elliott wave 3 leg, which tends to be the big move on any kind of up or down move in price action. The Elliott wave 3 leg, it tends to be the biggest moving leg. So that means this recount, the system will automatically recount it once we get forward in time. And then that means this move lower is off the table. It doesn't mean we can't get down there, but the odds now don't favor that. What I'm looking for here is there are a couple of key pivots that I want to stay above, but you can see these key price levels: 27.28, 26.34, 24.98. So call it 2,500, and then 23.98, call it 2,400. So these are key levels, guys. We want to hold them. You can see here as we've been kind of porpoising higher from here to here to here to here. These is a porpoise move higher, right? And then you can see the corresponding porpoise move lower here with the MACD. So we're getting that divergence again on this 240-minute chart that does suggest we're going to come down and test this area down here. Maybe not early in the week. We had a lot of momentum on on Friday. And all of this can change now if we get more good news on drug treatments like remdesivir, which was the one that Gilead put out that we got good news on, which helped the markets on Friday. But we've got to just see how this thing is going to play out. Just looking at the charts, it does suggest a little bit of a profit-taking mode and a pullback here into this green zone here, the green cloud, which would give us somewhere between these levels right here, around 27.52, 27.28 kind of area. Now, if I were to show you a different chart, let me just get that off the screen here. And let me get this chart up here. It's a cleaner chart. There's not much on it, but I wanted to show you from the peak to the trough down here. You can see I've got a Fibonacci extension off the trough down here. And as we come back up here, you can see we held a little bit here at the 50% of the 50 percentile. Let me clean up the screen here first. You can see here we held up just a little bit here at the 50% level, but then we've gone blowing through it. So I don't see us getting up above the 29.31 area. Remember on the other chart I said 29.78 roughly. This level right here would be a level that um, I don't see us taking out up above that level. Let me see if I can just draw that a little bit better there because my mouse slipped a little bit on me. So if I were to draw that up like that, right, that would suggest that we break to the downside. This was an ascending triangle. Normally they break to the upside, but we entered it from the top down. And sure enough, we broke it to the downside right here. And then we entered into this very tight uh, move like that, right? And it was a very tight channel that we stayed in, just like that, all the way down. And then we broke this channel to the upside. So I don't see us coming up to this level right here, all right, which puts us right around 31.20, somewhere in that area. You can see on the E-minis on this daily chart, we are above the 50 EMA. We're sandwiched between the 50 EMA and the 200 EMA. Okay, so there's going to be a lot of overhead resistance sitting at that level right there. I believe we're going to get a little bit of a pullback before we get above this level. Now, if we get a pullback and we find support right around the 38% extension off the lows, that would be a good thing. You can see we just kind of sat there for a pretty good little bit, and then we moved up. This was the upsloping trend line that we broke right here from December of 2018. This upsloping trend line goes all the way back from March lows, March 9 lows 2009, all the way to today. And you can see we broke it, but just briefly, and we came back up and we've maintained that level. So this is my go, no go line. I want to stay above this trend line, even if we pull back, right? And you can see the distance between the fib nodes right here, about 150 point difference. So it's a pretty big move, but in this market, it's just 1 or 2 days with a big down move, should it happen. All right. So that's kind of where we're sitting. We're almost sitting right in the middle right now here. This is the middle from the lows to the highs, the trough to the highs up here. This 2786 is roughly sitting right at the middle. So we're just north of that, just a little bit. So remember, bull rallies and bear markets can run up to the 61.8 extension off the trough lows, the first lows, and then roll right back over again. Okay, so just keep that in mind. Now, let me just clean up the screen. I'm going to take you to another screen here. I got a lot of them working on my charts here. We're gonna go take a look at some other stuff here. So let's just come over here and let's go look at this right here. We're gonna go look at the candle patterns, and you're going to see here there is a tremendous, should we make new lows? I mean, should we take those out? You can see all down here, all of these levels down here. That is a ton of support, guys. I mean, it's just it's like a bulletproof vest. I mean, you've got all these layers of steel in here. You got the post-Brexit vote lows. You've got the pre-Brexit vote lows. This was in 2016. You got the overnight Trump election lows before it took off once he was elected and I guess officially confirmed around 2 or 3 in the morning, East Coast time. So all of these are going to serve as support should we get down there. Now, at this point in time, I don't believe we'll get there, but that's kind of what I'm looking at, right? And you can see here, as I said, we just taken out the 50 EMA. We're in a natural resistance zone right here, and then we have the 200 EMA right up here. All of the because we moved down so fast, most of the trading volume has occurred at the 3100 level, going back 150 days. All right, so there's a lot of overhead up here that if we get up here, they're going to sell. They're going to use it as an opportunity to reduce their position size. They're not going to stay in their stock. So there's a lot of overhead supply here that I just don't think we're going to be able to get above. Should we get up there? I think we're going to kind of roll back over and find ourselves somewhere back down in this area here, somewhere between 25 and 2600. If we can hold that 2700 level, that would be really good, but it's going to be really hard to do. Now, we may get some momentum that kind of just extends our upside, but I don't think we're going to get above the 200 EMA, which is sitting at 30.10 right now. Okay. Now, if we look at NASDAQ, let's look at the NASDAQ 100 futures. If you look at this, you can see during the week or during the day on Friday, it actually moved up into the green, right? I mean, we moved above our 2019 close price, and now we closed down below just a little bit on the NASDAQ futures, the 100. These are 100 largest companies in NASDAQ. So for all practical purposes, we're almost break even for the year for NASDAQ. NASDAQ has obviously led the way higher. Now let's look at the Russell. If we look at the Russell, I mean, this one is really down in the dumps. If you can come down here, you can see off of the 2020 high, the Russell fell 43.66%. That's a huge downdraft. That's how low the Russell fell. Now we're up off those lows, but we're still down very low. It is so underperforming everybody else. Now this is small cap. Now if we look at small cap growth, which is IWF, look at this. It's back up over the 200 and over the 50. So small cap growth fund, it's some of the larger companies in the Russell have done very well. Okay, so and the ticker for this one is IWF, India Whiskey Foxtrot. So it almost looks like a completely different chart from that one to where are we here on this one? Where'd that sucker go? From that chart right there to this chart right here, right? Completely different. We're well below the 50 EMA. We're well below the 200 EMA. So the small cap growth in the rut is looking good. But these have lagged dramatically behind. We're off the lows, but still lagging a pretty good little bit. Now, if we come in here and we take a look at our volatility, and if we look at the VIX, right? Well, naturally, we moved out of the black swan area into the 40s, and looking at this daily here, we're now below the 40s, and we close the week now at 38.15, in the high 30s. If you remember with the 08-09 financial crisis, we came off the highs and stayed in the high 30s. Then we pitched back up into the 50s again and then rolled back over. We did not make the same highs in volatility, although we made lower lows in 08 and 09, and that's what is probably going to happen this time as well. So if we go lower, we're going to see vol go higher, but I don't think we're going to get it into the 70s and 80s like we saw before. Okay. And if we look at the front month skew, that's taking the VIX less the May futures, we're still in a backwardation. We're still in red. So we're in still a fear. In fact, if we look at the back month, the June and July vol future structure, we're in the red here too. I mean, we literally are in a backwardation going all the way back through almost to the end of this year. Okay. October is the lone holdout with the presidential elections. You'll see vol pop in a little bit. From September to October, and then it goes back down again in December. So that's a little bit about what we're seeing here. And then of course, if we look at bond market came down a pretty good little bit. We're running sideways in bonds right now. If we come down and retest our lows, I think bonds will come up. And in that particular case, and what I'm going to want to do is short bonds. So if we go up any higher than this, I'm going to be an active seller of the bond market. But near term, with the Feds buying across all durations, you're going to see bonds supported, at least for the near term. I don't think there's going to be any inflation near term. Longer term, I think we're going to see some inflation kick in. And like I said, if we look at the interest rates, we look at the 10-year interest rate right here, you can see it closed at 65.4 basis points. So we're still down very low. And the Feds are keeping it down there for a reason. Let's look at the US dollar. The US dollar is another one, okay, that we're above the 50, above the 200. This big move here, everybody was trying to grab dollars as the market was crashing, everybody and their uncle. And then the Fed stepped in and did these reverse swaps with all these different countries, making the dollar more accessible, so that it didn't punish a lot of these other countries, especially emerging markets. And you can see the dollar come back down, but it looks like it just wants to bounce a little bit higher here. But the Feds have created a little bit of a false market for the dollar. Now, longer term, I'm going to be bearish the dollar. Shorter term, I think it's going to be chopped maybe a little bit higher. Okay, so that's kind of what we're looking at on the dollar. There's other issues and other currencies that for our members this Sunday, we'll go through and take a look at. Now let's look at gold. Gold was down almost 40 points on Friday. Okay, there is not going to be any inflation for the next year. Gold is a good play when you believe inflation's coming back, but if the dollar is stronger, gold is also pushed down a little bit as well. So I think longer term, like the dollar, I'm going to be bullish gold. Shorter term, we're going to be in this fairly choppy range. But if it comes down a little bit lower, I'll start nibbling on the long side. I think over the next 2 or 3 years, as I was telling my members in 2022, 2023, I think we're going to have a big recession and we're going to pull back more than where we did right now. We'll be back 45 to 55% down, but more on that for our members and some of our longer term stuff. But this is where we're sitting right now. Okay. Now we've made some money in some of the metals that we've been trading off some of the lows. So these are some easy trades. Members, we'll go through that in our session this Sunday evening. Let's take a look at oil. Oil is kaput. It had a low of 1731. So this is the front month contract. The next month out goes up to like 25 or 26. So there's such a strong contango in the oil market. It is very difficult to play. You can't just say, oh, well, oil's $17 a barrel. So I'm going to go out in the futures market into December and just buy a couple of calls because I know by December it's going to be higher than that. And you'll be correct. But when you buy options on the futures market, you're going to be buying options on futures that are already up in the mid 30s right now. That's the steepness of the contango. Um, that we have in the oil markets. And you can't trade USO because USO's got a huge negative a roll yield because they try and use the oil futures. They're selling the front month and buying the back month. And when the back month is higher, then you're selling low and buying high, which is just the opposite of what they should be doing. So that creates downward drag on USO. So USO is not another way to play that. Now, for our members, I'm showing you ways that we can play the oil market longer term. Otherwise, it's very, very tricky. Okay, and if you were to just buy an oil futures contract, well, then you got to roll it over every time one expires. And again, you've got that huge contango. And when you roll over in a contango market, you're going to get killed. You're just going to get killed. It's just not the way to go. And then there's some things going on in the nat gas market and gasoline that we want to take advantage of. But you've got these skews or these contangos that just really make it very difficult. But there's another way to play it, which for our members I've talked about. We'll go through it in more detail. And then we got some issues in ags and meats. You may have been seeing some of that on the weekend news. But members, we'll go through it in more detail this weekend. If you're not a member of our group, I highly encourage you to come in and check us out. We're doing really well. And I think over the next 12 months, there's going to be some great opportunities. I mean, just really some good opportunities, but there's going to be some scare the children moments as well. So members, I'll see you this Sunday evening. Everybody else, I'll see you for the weekly roundup for next weekend, or come on in. Would love to see you on the inside with our group. Take care, everybody. Ciao now.